Good evening, everyone. Welcome back after a long break from my end. In the last class, I discussed something about capital structure problems, capital structure uh, calculations. So, if I just try to recap what we have done in the last class, uh, 3 points or three concepts that we have learned in the last class. One is about selecting the most appropriate financial plan. Select any one out of it based on obviously some sort of logical thing, and that was we calculated earnings per share. And in case if the question was also telling you what is the price to earning ratio, PE ratio, we used to also calculate the market price per share and then decide which of the three financial plans is the best one. Right. So our selection criteria was for the plan with the highest EPS, and the other is plan with the highest market price per share, highest NPS. Okay. So that is about these things. Now, one point was this. Second point that we discussed was about financial break-even point. So what was financial break-even point? Financial break-even point was that level of EBIT, that level of earnings before interest and tax, at which our earnings per share was zero. It means if my EBIT is more than the financial break-even point, I will be making profits. If it is less than financial break-even point, I will be in the loss zone. Right? And we know that if you have debentures, if you have debt, if you have preference shares in your balance sheet as your capital structure, you will have a higher financial break-even point. Right? So we termed those plans to be more risky. So financial break-even point was actually telling us how risky our financial plan is. A higher break-even point indicates you need to earn a greater degree of EBIT to earn profits. Okay, so that is one thing. That's the second point that we did. Third point that we did was financial indifference point. Third point that we did was financial indifference point. What was indifference point, sir? It was that level of EBIT at which two plans were having same amount of EPS, or we can say both the plans were having equivalent earnings per share. Both the plans were having equivalent earnings per share, and that's where we said that those are the two indifference points. Those are the financial indifference point. If your expected EBIT is more than financial indifference point, you will go for a risky plan. If it is less than that, then you will go for a less risky plan. Right, guys? So that is what we have discussed already. That's what we have discussed already in the previous class. Now, this session is going to be something really very, very interesting, guys. Right? These questions are going to be really very, very interesting. I'll be sharing the questions as well as the solution sheet as well as what we have done. Some of the questions that we'll be doing in the class, that's definitely will be there. Moreover, the remaining questions which are acting as a homework for you, those questions as well as the solutions will be there. So I'll upload it after today's class. After this entire thing of capital structure concept or the theory, the chapter name itself is theory. So capital structure theory. So we are discussing over here something called as capital structure theory. Capital structure theory. Now, as the name of the chapter suggests, this is actually a chapter which is based on some concepts, based on some debate. In fact, in the entire chapter, you will find there's a debate ongoing between two set of people. Each one of them is giving some sort of explanation. Each one of these people are giving, some sort of backing explanation reasoning as to why do they say it in those lines, and even the opposite side says the same. So there's a debate going on. Sir, what is the debate? What is the debate? To understand the debate, let's simply talk of two companies, sir, X and Y. Both the companies are into same line of business. Both the companies are into same line of business. Both the companies are generating same amount of EBIT. Identical, exact identical. Right? Identical. Both the companies are exactly identical. The only difference that they have is capital structure. The only difference that they are having is the capital structure, guys. So what is the difference in capital structure? Well, in capital structure, the difference stands like this. Company X is 100% equity financed. Company Y is having partly equity and partly debt. You can say it can be a combination, sir, 80-20, 20-80, or 50-50, 60-40, whatever the ratio is. But the thing is, both the companies are having same business. EBIT is also same. Just the capital structure is different. So what about the amount of capital? Well, amount of capital is just one and the same. Total capital employed is again same for both the companies X and Y. Total capital employed is same for both the companies X and Y. The only difference that is there between these two companies is the way they are funded. In this case, company X is having 100% equity. Company Y is having some amount of debt and some amount of equity. Okay, so that is your companies X and Y. These are the two companies. Okay. Now, what is the debate, sir? What's so great about it? Well, the debate stands is market value of both the companies. Market value of companies. Remember, we're talking of market value of companies. We're not talking of market value of only the equity shares. Okay. So the debate over here, guys, is what can we say about market value of both the companies? Market value of X and Y. The point is X, company X and company Y, everything is same. Only the capital structure is different. So the question is whether these two companies will have same market cap, or are they going to have different market cap or different value, different market value, not market cap, market value of the companies. Is it going to be same or is it going to be different? That is the debate going on over here. Okay, so don't jump to a conclusion, sir. It will be same or it will be different. Both of them are giving some sort of explanation for that, and we have to respect their explanation and appreciate their approach to understanding, or appreciate their approach to create a theory, to create a concept. Okay, it's going to be really interesting, guys. So what sort of discussion are we having? We are having the discussion, well, capital structure, that's the debt equity mix, affect the value of the company. Is it going to affect the value of my company? That is, will taking debt for investment in business affect its value? Or you can say another way of looking at it is, there are two individual companies, two identical companies, out of which one is a geared and other is a non-geared. Then will there be any difference in the values? Will there be any difference in the values? So one set of people say yes, both the companies will have different value. Another set of people say no, they will have, they're not going to have any different values. So the first set of proponents say value of company or business will be affected by capital structure. It means they say yes, capital structure is going to change the value of your business or company. There's another category which says value of company or business will not be affected by capital structure. Okay, so that is these two set of theories. The value of company or business will be affected by capital structure, and the other case is value of company or business will not be affected by capital structure. Okay, so those who say that yes, the company value is going to be different due to different capital structure, that's a relevant theory. And those who say that that it's not going to be affected by capital structure, then it's a irrelevant theory. So we have a relevant theory, we have a irrelevant theory. Okay, or we can say theories of relevance, theories of irrelevance. Remember the 4 theories that we are going to discuss today, all of them are Nobel Prize winning theories. You can understand the greatness of the concepts that we are going to learn. All these 4 theories are Nobel Prize winning theories some 40-50 years or 30-40 years back. Okay, so the good thing, or we as a person should respect the theory, appreciate it, right? There's no harm in identifying, so there is some mistake in this theory. That's all. That's okay, fine, right? But the thing is, you should appreciate the approach with which they have developed these theories. They have developed these concepts way back when we didn't have any amount of computing or any sort of greater computing powers, right? So 2 set of theories. What are 2 set of theories, sir? One is a theories of relevance, other is theories of irrelevance. Okay, so what are the theories of relevance? They say that the value of the company or business will be affected by capital structure. That is, the 2 companies which we discuss right now, one is having loan, other is not having any loan. So then in both the cases we will say that are the values same or are the values different? So theories of relevance, theories of irrelevance. What are the name of those theories? You can say there's a net income approach or a traditional approach. Both of them are what? Relevant theories. So what do you mean by relevant theories? When you say relevant theory, it means that these 2 people or these 2 theories are stating that a company with a loan will have different value than the company without a loan. Theories of irrelevance means what? These are the theories, that is net operating income approach and Modi-Gilani-Miller approach. What are these 2 theories stating? They are saying value of the company or business will not be affected by capital structure. It means you take loan, you don't take loan, the value of your company is going to be a constant. Okay, so these are the 2 set of theories that we are going to discuss. But before we go about discussing these theories, it's better for us first to learn some basic concepts. That is about some valuation of certain assets. I presume that you are done with your capital budgeting, right? Correct, guys? I presume that you're done with your capital budgeting. You have information about how to calculate the time value and anything. So with that presumption, I'm just going ahead. Okay, listen. Whenever I want to value anything, value of an asset, or any investment, any asset, any investment you say, that is generally present value of future cash flows. So value of asset is basically present value of future cash flows, right? Okay, so sir, it's a present value of future cash flow. So we need to have an understanding that if I want to value any asset, be it a car, be it a building, be it a house property, be it a share, my idea is always to value those things as what are the future cash flows I'm going to get out of it. Because if you are not having any future cash flows from that asset, then it's not at all asset only, because no benefit. Right? So whenever we are valuing anything, this is a well-established fundamental, widely accepted in the world. And the most basic idea of finance is that value of asset should be present value of future cash flows. Okay, so in future, whatever cash flows you're going to get, take the present value of it. That will be your value of asset. Right, guys? Okay. Now let's go about valuing certain things. Now this chapter or these theories are subject to many assumptions. Right? With many assumptions. It's based on certain assumptions, and accept the assumptions as it is. Don't challenge them, because without assumption, no theory can work, no scientific invention can work. Right? Because in medical science also, whenever any medicine is developed, there is certain underlying assumption that human body will be able to accept some amount of medicines. Right? So even in finance, we have certain assumptions. You'll find that these assumptions were held in the initial phase. That is during the first phase, when the finance as a area of study was just getting developed. In that time, we had a lot of assumptions. Later on, we had many studies also, many research undertaken, many studies have been undertaken in which they have done away with the assumption, and they were trying to look at what will be the impact of removal of those assumptions. Okay. So value of assets, as we say, present value of future cash flow. Now my interest over here, with a very absurd assumption as of now, I agree. But then let's understand the theory with that assumption itself. Later on, we will remove that assumption and also see what is the impact. So, assuming no tax regime, it means we are working in a world in which corporate earnings are not taxed. Corporate earnings, or in fact, none of the incomes are being taxed. So how is that possible? As I said, assume it, just accept it as it is, because we have certain countries where there are no taxes, right? There are certain countries in the world in which you don't have to pay any tax on your income. That's perfectly fine. So assuming that we are having no tax, we are talking of valuing companies. So I am interested in typically valuing equity. Tell me, what is the income that equity shareholders get by investing in the equity shares? What is the income that equity shareholders get? Is it only the dividend? No, sir. Whatever company is earning, that entire thing is ideally attributable to whom? To the equity shareholders, right? So assuming no taxes, what our first assumption? Second assumption is no preference share capital. So when I say value of equity, income for our equity shareholders is profit after tax. Income for equity shareholders as a whole, the entire class of equity shareholders I'm talking. We're talking of the entire class of equity shareholders. So income for them is the profit after tax, because it is only after profit, after earning profit after tax, you pay, you distribute dividends to your equity shareholders. So value of equity, we say PAT for year one, take the present value of it. So present value of profit after tax for the first year should be divided by 1 plus K. So PAT for year 2 should be discounted as dividing it by 1 plus K square. PAT for year 3 should be discounted as 1 plus K cube. We just add all of them and take it up to indefinite period or infinity. So value of equity, we say profit after tax for year 1 divided by 1 plus K, profit after tax for year 2 divided by 1 plus K square, profit after tax 3 divided by 1 plus K cube, and it goes on till infinity. Now I bring in another assumption. Another assumption that is being undertaken over here is 100% dividend payout. 100% dividend payout. I think if you have done cost of capital, you should be knowing that there will be growth in the dividends, or there will be growth in the profit after tax, and that growth is the formula given as B into R. Right? Growth was the formula given as B into R. I'm pretty sure that you might be aware of this. When you say B into R, B was denoting what thing? B was denoting the retention ratio. Right? B was denoting the retention ratio. So B is denoting retention ratio. Sir, if you are assuming 100% dividend payout ratio, tell me what will be these PAT figures? Are we assuming that there will be growth in the profit after tax? Or is it going to be that PAT is constant till infinity? What will be the implication of assuming that 100% dividend payout? What is the implication of 100% dividend payout? Can I say no retention? If you're not retaining anything, you're not reinvesting anything, your profit after tax is going to be a constant figure forever. Right? So, since J is equal to B into R and your retention ratio is 0, so we say G is 0. So if growth is 0, can you tell me guys what will be the value of this? Can I say if your growth is 0, PAT 1 will be same as PAT 2, will be same as PAT 3, and will be same as PAT n. So let us assume that it's just the profit after tax. Let's assume it's just profit after tax. So our value of equity will be PAT upon 1 plus K plus PAT upon 1 plus K square plus PAT upon 1 plus K cube, and it just goes on. So from this you can say, sir, PAT, let's take it as common. Let's take it as common. If PAT is taken common, we have 1 upon 1 plus K plus 1 upon 1 plus K square plus 1 upon 1 plus K cube, and it goes on till infinity. So that is profit after tax. Now what will be this figure, sir? This is your typical mathematical problem, guys. Geometric progression. It's a geometric progression. This is a geometric progression in which A, or the first term, is 1 upon 1 plus K. Common multiple R is again 1 upon 1 plus K. So my formula is, anyways, the S infinity is A upon 1 minus R. So A is 1 upon 1 plus K upon 1 minus 1 upon 1 plus K. So this is profit after tax 1 divided by 1 plus K, and this is 1 plus K minus 1 the whole divided by 1 plus K, and over here also 1 plus K gets cancelled, and what we are left out is profit after tax divided by K. That's the value of equity. Simple formula. Sir, why did you complicate so much? I just wanted to give you an idea, guys, as to how do we come up with this thing. I've just derived this one formula, value of equity, to be PAT upon K, profit after tax, upon cost of equity. That's the only clarity I have given. Right? I assume that this formula is quite clear with the derivation part. So value of equity is going to be PAT upon K. So that's the first formula. Second formula, value of debt. Second formula, value of debt. What is it going to be? Sir, for debenture holders, it is the interest which is the income. So interest divided by K, interest divided by KD, cost of debt, will be value of debt. Right? Interest divided by cost of debt, KD, will be your value of debt. Okay. Sir, what is the value of the firm, value of the entire business? what is the value of the entire business? So value of the entire business is EBIT upon KO. Value of the entire firm is EBIT upon KO. Okay, KO stands for overall cost of capital. This is the third formula. And another formula which is quite obvious, sir, value of firm will be equal to what? Will be equal to two things. What, sir? Value of equity plus value of debt. Value of firm will be equal to value of firm will be equal to value of equity plus value of debt. Okay. Value of firm will be equal to value of equity plus value of debt. These are the four basic formulae which we should remember. Right. After that, we'll also, we'll do away with these assumption. No tax regime. We'll be doing away with these assumption and just checking out what is the impact on the theories. Okay. So value of equity, value of debt, value of firm, using EBIT approach, as well as value of equity plus value of debt. So we need to add both of them. Right. So I hope these basic formulae are clear to everyone. And if this is clear, then we can go for the first theory to be discussed, which is a net income approach. Just confirm, guys, are we good with this formula? I hope we are all good with this formula, guys. Waiting for your response. Come on, guys, tell me. All these four formulae, are they clear with you? Are we all good with this four formulae, guys? Then we can proceed. Yeah, I'll just wait for maybe 10-15 seconds and then we'll go for the next discussion. Yes, VF means value of the firm. Value of the firm means value of the business. Perfect. Everyone clear? Good, guys. Now let's go for the first theory to be discussed. Let's go for the first theory. So we'll be doing net income, net operating and traditional approach as like a story. Right? So story with all justification, no fairy tales. It's all perfectly based on logic, reasoning. There won't be any Harry Potter in this story. There won't be any witch which is roaming around in the room. Right? There won't be any Tom and Jerry story. So it's going to be really finance theory, which is going to be based on sound logic. Okay. And the beauty is, one theory is developed, some shortcoming is identified in that theory, and there is another theory which comes up. Again, in that second theory, there is some problem. That problem is identified. Third theory comes up. Right? That's how the research keeps on developing, right, guys? So let's go ahead without wasting any more time with the net income approach. Okay. Fine. So net income approach, let's understand it with the help of these numbers and also with sound logic also. Now, the first thing, net income approach, the first point which these theories or proponents place, net income approach, it was by a researcher called as Durant. Now, I hope you guys might have seen some court cases in movies, right? Hindi movies. There have been many cases, right? So any legal case, any judicial case you might have seen, they place before the judge the facts and circumstances. They try to prove with their justification, right? So something of that sort, mini justification is what is given in these theories. Are these theories applicable on listed companies? Yes, definitely they are applicable, but subject to those assumptions, guys, right? Fine. So net income approach, what is this theory being stated? First point which they place is that, sir, cost of debt is less than cost of equity. Tell me guys, is cost of debt less than cost of equity? Is their first point correct or incorrect? Are they correct in stating that cost of debt is less than cost of equity, or are they incorrect in stating that cost of debt is less than cost of equity? Are they true in stating that, sir, cost of debt has to be less than cost of equity? Right? So are they correct or are they incorrect? Definitely correct, sir. You might have learned in cost of capital. So cost of debt is going to be lower because as a debt fund provider, as a debenture holder, you would always like to have a fixed return which is comparatively less riskier than the equity shares. So equity shares have a greater degree of risk, right? Equity shares are having a higher degree of risk and therefore they will demand a higher return. So if they're demanding a higher return, of course, cost of equity is higher. So first point is perfectly fine, sir. Ekdam perfect, exactly correct. No issues at all. Cost of debt has to be less than cost of equity. Now they connect this with another thing. Now they say, okay, if your cost of debt is less than cost of equity, then they say that if you increase your weightage of debt in your business, then overall cost of capital will reduce. Right? Overall cost of capital will reduce. Okay, so this is their second point, which they are connecting it with the first point. So looking at the first point, they say cost of debt is less than cost of equity. So if you increase the weightage of debt, your overall cost of capital will reduce. Okay, let us see, does it really happen or not with the help of numbers. See, in the first case, there was a company which was having an equity share capital of 10,000 and no debt. So of course, if I look at weightage of debt and weightage of equity, that's 0 and 1. Cost of debt, we say it is 10%, cost of equity is 15%, which is perfectly fine, sir. Cost of debt has to be less than cost of equity, which is very true. What is the overall cost of capital over here? We say that the overall cost of capital over here, it is 10% into 0 weightage and 15% into 1 weightage, which is overall cost of capital is 15%. Overall cost of capital is 15%. Okay. Now, what would happen if I just buy back some of the equity shares? I'll say, I don't want this much amount of equity shares outstanding in the market. Let me buy it back and replace it with the help of loan. That is, I'll take the loan and I will buy back the shares. I'll borrow from the market 10,000. I'll buy back the shares. So outstanding equity shares is how much? 9,000. So 1,000 debt, 9,000 equity. So weightage of debt and weightage of equity is 0.1 and 0.9. So weightage of debt and weightage of equity is 0.1 and 0.9. So what about the cost of debt and cost of equity? That's the same as 10% and 15%. So if you calculate the overall cost of capital, it will be like 10% into 0.1 plus 15% into 0.9. That should give you 14.5%. Yeah. Then as we see that you are increasing your weightage of debt, what is happening to overall cost of capital? Sir, overall cost of capital is getting reduced. If you're increasing your weightage of debt, overall cost of capital is getting reduced. Right? If you're increasing weightage of debt, overall cost of capital is getting reduced. Yes, sir, true. Second point is also true. That if you are taking more and more debt, the overall cost of capital will get reduced. That is, you're replacing your equity with debt. Third point, they say, as the KO reduces, value of firm increases. As KO reduces, value of firm increases. Okay. Prove it, sir. Very simple. Let us assume 3,000 to be the EBIT. And at each of these levels, I want to obtain the value of the firm. Sir, what about the value of the firm? How do we calculate the value of the firm? It is value of equity plus value of debt. Okay, there's another formula, EBIT upon KO, earnings before interest and tax, the income for all the investors upon KO. So that's like 3,000 divided by 15%, it will give you 20,000. 3,000 divided by 14.5%, that's 20,690. So as you observe, sir, overall cost of capital gets reduced, value of the company will increase, and that's true. Now, what does this imply? What does this imply, sir? If there is a 100% equity company and there are other companies, other similar companies which are having debt in their capital structure, the companies with the debt will have a higher value. Companies with debt will have a higher value. And that is what the conclusion of this theory is. Company having debt in the capital structure will have a greater value as compared to no debt company, and accordingly optimal capital structure that's there in the company should be take 100% debt, sir. Sir, it's not possible to have 100% debt. Very true. So take weightage of debt tending to almost 100%. That is, you can take 99.99999% debt and just 1 rupee maybe as equity. Right? You can just have 1 rupee as equity, but this sounds impractical, sir. Yeah, true. But because it was based on certain assumptions, this may sound to be, impractical. But the whole idea is the net income approach states that you should substitute your equity with debt to increase the value of the company, because that will, or that simply implies that the company without debt will be having a lesser value as compared to company with debt. Okay. Are we good, guys? Just look at this theory, guys. Are we all good with this theory? Logically, is it clear? Is it clearly understood, guys? Just confirm, is the net income approach or the story or the justification for this theory, is it clear? What's KO? KO is overall cost of capital, weighted average cost of capital. Weighted average cost of capital. Okay, are we good with this, guys? Net income approach. Just confirm, then we can go for the next approach. And if you're good, just identify what is a mistake that this theory is making. What is the shortcoming of this theory? Something which is overlooked by this theory. Can you identify that part? Because if you're able to identify that part, automatically you are, building up the second theory. So can you just identify what's the shortcoming over here? Can you identify what's the shortcoming over here? There is a mistake. There is a fundamentally important thing which is missed out by this company, or that's being mistaken, overlooked in this theory. Can you identify what is that? Can you identify? Let me see if there's anyone. No equity mistake. No. Risk increases due to debt increase. Okay, Charu. Perfect. Risk increases as the debt increases. So as the risk increases, what will happen? What will be the implication of that thing? That if your debt increases, risk will increase. What will be the implication of that thing? What will be the implication of that thing, guys? What will be the implication of that thing? If you're saying that risk increases, what is it going to lead to? What is it going to lead to? Risk increases. Okay. Let me tell you, think from the point of view of equity shareholders. Just assume you are an equity shareholder in this company. You were expecting 15%. You were expecting 15% when the company was not having any debt. Now, if the company is taking debt, risk is increasing, will you be still expecting 15% as the cost of equity, or will you be still be expecting 15% to be a required return? Will you still be expecting that you should earn 15% on it? Of course not, right? How can my expected earnings from the company, or how can my required earnings from the company be same when the company is taking more risk? So as the company is taking more risk, sir, it is but obvious that our equity shareholders are going to demand a higher return, right? So if they are going to demand a higher return, how are we going to look at it? That's going to be given in this approach of net operating income approach. Now what's happening over here? See, in case of net operating income approach, they say, first point, they agree with net income approach, that cost of debt is less than cost of equity. Perfectly fine. We are okay with it. We are not challenging that part. But for the second point, they say, as the rate of debt increases, KO will reduce. Okay, that's fine. But that is under an assumption that your cost of equity will remain same. But then cost of equity cannot remain same, right? Because logically, if you are taking more and more debt, if you're levering your company, of course, your overall cost of capital will get reduced, you will feel like. But then what about the cost of equity? Cost of equity will be definitely higher. More will be expected, right? So they say, as the weightage of debt increases, one effect is that KO is being pulled down, but there will be a side effect. And side effect is the cost of equity will start increasing. Your cost of equity will start increasing. And as the cost of equity starts increasing, KO is going to increase. So as the cost of equity starts increasing, KO will increase. So there is a downward pressure. There is a downward pressure created by weightage of debt. There's a downward pressure on KO created by a weightage of debt. But there is a simultaneous upward pull in the KO because KE is increasing. So they say that these two are going to offset each other. KO will be pulled down by weightage of debt. KO will be pulled up by high cost of equity. And the implication of both the things is that KO will remain same. Overall cost of capital will remain same. So prove it. Let me just prove it over here. See. Debt of 1,000, equity of 9,000. So weightage is 0.1, 0.9. So sir, overall cost of capital, you say KD is 10 and KE is 15. Overall cost of capital is like 0.1 into 10%. Then 0.9 into 15%. So overall cost of capital will be 14.5%. Overall cost of capital is 14.5%. Okay. So overall cost of capital is 14.5%. Now, if you have cost of debt and cost of equity 0.5, 0.5, KD is 10%, KE is 19%. Overall cost of capital is 14.5% again. Here if you say as the weightage of debt increases, KE, that is equity shareholders expectations, start increasing. So 15, then it went to 19, then it went to 55, but overall cost of capital will remain constant. Now definitely I know what you guys are thinking. Sir, how do you know that KE will exactly increase in the same amount, in the same percentage that KO will remain same? That's again a normal thing which has been identified in many research papers. We are not going to discuss that because that's not a part of our syllabus right now. So assuming that sir, KE will increase in the same proportion to make the KO as a constant figure, right? That's a valid point to be noted, but we are not going to discuss on that right now. Plenty of research has been done on that. As and when you guys, reach up to postgrad level, when you start doing your PhD and all, you will realize that many such theories have developed and alternate assumptions and alternate things, alternate models are also there. Okay, but just as I told you, accept it, appreciate the theory that is being developed. So they gave a story that if you take more and more debt, So overall cost of capital will be pulling down, but KE will be increasing, so that will be pulled up, and then KO will remain constant. Okay, so weightage of debt increases, cost of equity increases simultaneously, and overall cost of capital remains same. It remains same or stagnant. Okay, and obviously, sir, as KO is constant, value of the firm will be constant. Right? So value of the firm is going to be a straight line. There's no going to be increase in the value of it. So conclusion over here, they say, sir, value of business is not affected by capital structure, and rather we say, sir, any capital structure is optimal as the value is a constant figure. So any sort of capital structure, right? Any sort of capital structure is going to be same, and that's not going to be deciding whether it will be higher or lower. Okay, so just clarify, guys, are we good with this net operating income? And I hope you understood what fact was being overlooked by this net operating income, net income approach theory. Let me look at the queries. Sir, here WACC based on market rates. Yes, it's based on market rates. Correct. Because here we are talking of market values only. Okay. Now, there's a mistake in this theory also, and that is being identified by the next one. So, in this also mistake, yes, there's a mistake. The mistake is, how can you assume that bankers are going to give you the loan at same constant 10% for whatever amount you borrow? That is, if you borrow 1,000, they'll charge you 10%. If you borrow 5,000, they'll still charge you 10%. If you borrow 9,000, they'll still charge you same. So that's not the scene, right? That's not the typical scenario, right? So this was countered by the next theory. That next theory is simply the traditional theory. Let's understand this traditional theory. Let's understand this traditional theory with the help of this graph or the chart. Right? Now, in this chart, what this traditional theory says is, it states that when a company is borrowing money, it won't be charged the same rate of interest for any amount you borrow. And neither will the equity shareholders be requiring a higher return for very small amount that you borrow. That's not the case, right? So what we say over here is, there are three phases: phase 1, phase 2, phase 3. Right? So phase 1, phase 2, phase 3. 3 phases of borrowing. The first phase is about, borrowing some nominal or minimal amount. And the first phase is about borrowing some nominal amount or some amount of minimum money, minimum amount of some capital. Second is crossing that threshold and borrowing a higher amount. Third stage or third phase is, having a great degree of loan. Okay, so now what is happening in each of these theories? See, in the first phase, it says small amount of debt will be taken. That will not affect the KD or KE. That is, if you borrow, let's say if you have a capital of 1 crore, and if you replace maybe 1 lakh, 2 lakh, or 5 lakh out of your capital with debt, if you're a 1 crore company and if you take a 5 lakh loan, it's not going to be a major thing. It's a very nominal thing. And equity shareholders also understand that's the very regular phase of borrowing, and they will not ask for higher return. Their expectation will not immediately increase because KE is a constant thing. Even KD, cost of debt, even our debenture holders or bankers won't be charging us a higher rate of interest because it's a nominal amount which is well within the limits. So if this holds true, sir, KE is constant, KD is constant at the bottom. What will happen to KO? Remember the net income approach. Remember the net income approach, guys. KD is constant, KE is constant, and if you take a greater amount of debt, your weightage of debt is increasing. So what's happening? Your KO is falling. Your KO or overall cost of capital is falling, right? So KE is constant, KD is constant, overall cost of capital is falling. Like a net income approach, right? So the value of firm will increase similar to net income approach. So for a small amount of loan, if you take for your regular day-to-day business, then KO is not going to be impacted in a major extent. So KO will, KE and KD won't be impacted. So KO will fall. Perfectly all right. That's the first phase, phase one. Let's go to the second phase. Now in second phase, bells start ringing for equity shareholders. Now they say 1 crore capital, but now the company is actually taking 20 lakh loan. It is somewhat risky scenario. It means the company is going to invest in some profitable projects and the company is going to have a higher profits. That's one scenario. Or maybe the company is facing crisis. So we should start requiring, or we should start the company to give us more amount of return. So you can see KE starts increasing. So KE starts increasing due to higher debt. Cost of equity starts increasing due to higher debt. Overall cost of capital will become constant. Overall cost of capital, KO, will become constant, as we see over here, because KE is pulling it the upside, KD is pulling it downside. So weighted average cost of capital will become a constant figure, and that means value of the firm will be remaining constant and similar to net income, net operating income approach. Third phase is where company is taking huge amount of debt. Out of 1 crore capital, it has got like 80 lakh, 90 lakh of debt. Of course, sir, bankers are not going to give you the same rate of interest. Bankers will now ask for a higher rate of return. And as the bankers are going to ask a higher rate of return, already KE was increasing. KD also started increasing. So what will happen to the overall cost of capital? That will also start rising. So KD and KE both increase. KO will also increase. Value of the firm will start decreasing. So if I ask you, sir, from the point of view of valuation of the company, in which phase is it going to be the highest? Phase 1, phase 2, or phase 3? In which of these three phases value of the company will be highest? In which of these phases of the company, in which of these phases value of the company is going to be highest? In which of these three phases value of the company is going to be highest? Tell me guys. Is it going to be phase 1? Is it going to be phase 2? Is it going to be phase 3? Which phase do you feel that the value of company will be highest? Yeah, phase 2. Perfect. Perfect, Rohan. Correct. True. It's the phase 2. Because in phase 2, you will find that the overall cost of capital is lowest. And as the overall cost of capital is lowest, your value of the firm will be highest. Right? So this is the optimal capital structure. This is a typical optimal capital structure. Perfectly fine. All the three theories just confirm, guys. Are we all good with the net income approach, net operating income approach, and the traditional approach? We'll go to the fourth theory at a later point, but right now I just want you to confirm me, guys. Are we all good with these three theories of capital structure? Are we all good with this, guys? Are we good, guys? Perfect. Fantastic, guys. Then let's do one thing. Let's go for some practice questions, some practical problems. And then later on, we'll take up the last theory. Okay. So here we have the questions. I'll upload this question as well as my handwritten notes. So need not worry about it, guys. Let's go for question number 1. C. Lakshmi Limited is expecting an annual earnings before payment of interest and tax of 2 lakhs. Okay. So this is annual earnings of, is expecting an annual earnings before interest and payment of taxes. So that's like earnings before interest and tax. How much, sir? 2 lakh. Okay. Then the company in its capital structure has 8 lakhs in 10% debentures. Company in its capital structure has 8 lakhs. So we have got debentures of 8 lakh. And of course, debentures at 10%. Cost of equity or capitalization rate is 12.5%. Okay, so cost of equity is 12.5%. For all other numbers, you're required to calculate the value of the firm using net income approach. Also compute the overall cost of capital. So we need value of firm and KO. So required things are value of firm and KO. How do we do it, sir? They're saying net income approach, but that's quite obvious enough, right? So there's a debenture of 8 lakh. Let's do one thing. We'll prepare a short income statement. We'll start with EBIT. EBIT of 2 lakhs. From that, we are going to subtract interest, and that interest is going to be 10% of 8 lakh, which is 80,000. So that's 1 lakh 20,000. So EBIT minus interest 80,000. 1 lakh 20,000 is the profit before tax, right? Of course, sir, there is no tax. So profit after tax is same as profit before tax. So we get a PAT of 1 lakh 20. We've got KE. We have got cost of equity as 12.5%. Can we get the value of equity? Yes, sir, 100%. Why not? Value of equity, we know it is profit after tax upon KE. So what is profit after tax? That's 12, or I can say 1,20,000 divided by 12.5%. So 1,20,000 divided by 12.5%. 1,20,000 divided by 12.5%. That's 9,60,000. So value of equity is, guys, 9,60,000. Value of equity is 9,60,000. We already know value of debt to be 8 lakh. So overall value of firm is 17 lakh. Value of firm is 17 lakh 60,000. Right. So we got this value of firm. Now we need KO, overall cost of capital. So how are we going to get the overall cost of capital? Look at EBIT. EBIT is given to us. We know the value of the firm. We just have to divide it. Simple. Since value of firm is EBIT, value of firm is EBIT, upon KO. Value of firm is EBIT upon KO. So EBIT is 2 lakh or divided by KO is something we don't know. But we already know value of firm is 17,60,000. So, but obvious, sir, overall cost of capital is 2 lakh divided by 17.6 lakh. 2 lakh divided by 17.6. 11.36%. So overall cost of capital is 11.36%. Okay, so that's the answer to first question. Pretty simple. Let's do one more question. Question number 2. But I'll not solve it fully, but just look at the solution. Okay. See, assume in the illustration given above that a firm decides to raise further 2 lakh by issuing debentures and to issue proceeds thereof to redeem the equity shares. You are required to calculate the value of the firm according to NI approach, also compute the overall cost of capital. So based on this illustration, we want to raise a further 2 lakhs by issue of debentures and to issue proceeds thereof. Okay, so now in the second case, we are saying that in the first question, we are taking 2 lakhs more debt. So if we are taking additional debt of 2 lakh, that's like 8 lakh plus 2 lakh, that comes out to be 10 lakh. So value of debt will become how much? 10 lakh. Cost of debt remaining same 10%, cost of equity remaining same 12.5%. EBIT is still 2 lakh. So of course, sir, what will be the value of firm and overall cost of capital? We can get it very easily. Value of firm. For that, we will first talk of what is value of equity, right? So we can solve it over here on the similar lines, in a sense that the debenture is now no more 8 lakh, but rather the debenture is now 10 lakh. K is 12.5 and rest all remaining same. So what will change, sir, over here? Instead of interest 80,000, you will have an interest of 1 lakh. So profit before tax is 1 lakh. So PAT is 1 lakh. Profit before tax is 1 lakh. Profit after tax is 1 lakh. Value of equity is PAT upon K. PAT is 1,20,000 divided by 12.5%. It was in the earlier case, but right now we have the value of equity to be PAT of 1 lakh divided by 12.5%. So 1 lakh divided by 0.125. The value of equity will be 8 lakh. And value of debt is now 10 lakh, and the total valuation will become 20 lakh. So accordingly, our KO, overall cost of capital, will also change. It should be like 2 lakh upon 20 lakh, which is 10%. Okay, so second question is also on the similar lines. It's just that numbers are a bit weak. It's just the value of debt instead of 8 lakh, it's 10 lakh. Okay. Fine, yes. Let's go for another question number 3. Question number 3. See, Modern Limited is expecting an earnings before interest and tax of 4 lakh and belongs to risk class of 10%. you are required to find out the value of the firm and cost of equity capital if it employs 8% debt to the extent of 20%, 35%, 50% of the total financial requirement of 20 lakh. So here we say, sir, overall cost of capital is 10%, right? And they say that you are going to employ debt or weightage of debt will be 20%, 35%, or 50%. Weightage of debt will be 20%, 35%, or 50%, right? So if that's the weightage of debt, we can also get weightage of equity. Sir, weightage of equity is even more easier because it's just the 100 minus or 1 minus that weightage of thing, right? So we say weightage of equity is 1 minus the weightage of debt. So cost of debt and cost of equity is given. You can say it belongs to a risk class of 10%. It belongs to a risk class of 10%. You are required to find out the value of the firm and cost of equity. Right? Sir, 18 lakh, yeah, 20 lakh. It was, which was, oh, my bad, sorry. Perfectly fine. It's like 18 lakh. This is 18 lakh. Value of firm and overall cost of capital will be accordingly 2 lakh divided by 18 lakh. Correct. That's 2 lakh divided by 18, which is 11.11%. Correct. My bad. Okay, anyways, coming up over here. In this case, weightage of debt, weightage of equity is given. Cost of debt is given to be 8%, 8%, 8%. It belongs to a risk class of 10%. When you say risk class of 10%, remember risk class of 10% simply means the overall cost of capital or KO. Right? So overall cost of capital, KO is 10%. EBIT is given to a 4 lakh. So now the question is asking us, what will be the value of the firm and cost of equity? So let's first talk of value of the firm. The value of the firm will be EBIT upon KO. EBIT upon KO. Value of the firm will be EBIT upon KO. And sir, what will be the value of debt? Value of debt will be what? If the value of the firm is this one, which is 4 lakh divided by 10%. Right? Then in that case, value of the firm will be 40 lakh because 4 lakh divided by 10%. And value of debt will be simply out of this total value of the firm, 20% is debt. So 20% is debt. So therefore, value of debt will be 20 lakh. 4 lakh, 40 lakh divided multiplied by weightage of this thing. 20 lakh, or I can say there's some issue. 1 second. You're required to find the value of the firm, and I'll do what. Let's solve it first. Okay. Solve it. See, weightage of debt, weightage of equity, which is 20%, 35%, 50%. Weightage of equity is 80%, 65%, and 50%, right? And then we have KO given to us, which is 10%. We have EBIT given to us, which is 4 lakh. EBIT 4 lakh. So we have EBIT, earnings before interest and tax. We also have the overall cost of capital. So we can simply do EBIT by KO to be the value of the firm, which should be 40 lakh in each of the three scenarios. EBIT upon KO, 40 lakh is the value of the firm. Now, what will be the value of debt? The value of debt is like weightage of debt is 20% out of this total value, right? So out of this total value, we can say this will be weightage of debt multiplied by the value of the firm, right? So it will be 40 lakh multiplied by 20%, which should be 8 lakh. 40 lakh multiplied by 35%. 40 lakh multiplied by 35%, which is 14 lakh. And then 40 lakh or 50%, which should be like 20 lakh. So 20 lakh is the value of the debt. 20 lakh is the value of the debt. So we get value of debt, value of firm bhi aa gaya. So what it requires, find the value of the firm and cost of equity capital. So cost of equity capital, for the purpose of cost of equity capital, we will need the value of equity. Value of equity will be simply 40 minus 80 lakh. It is pretty simple. 32 lakh, 26 lakh, 20 lakh. It's the difference between them. Once we got the value of equity, we will need the figure of profit after tax. We'll need the figure of profit after tax because based on the profit after tax, we will get K, which is PAT upon value of equity. PAT upon value of equity. The profit after tax. Profit after tax is going to be EBIT minus interest. So tax not required because it's no tax scenario. No? So profit after tax will be 4 lakh EBIT. 4 lakh EBIT minus 8 lakh into the cost of debt is 8% minus 8 lakh into 8%. Then here it is 4 lakh minus 14 lakh into 8%. Then it is 4 lakh minus 20 lakh, which is the debt amount, into 8%. Let's go to those figures. So 8 lakh multiplied by 8% is 64,000. That's 64,000. Then that 64,000 will be subtracted from 4 lakh, which is 3,36,000. Then 4 lakh, or you can say 14 lakh multiplied by 8% minus 4 lakh, which is 2,88,000. Then 20 lakh into 8% minus 4 lakh, that's 2,40,000. Okay, and then finally talking about the cost of equity, which will be PAT upon value of equity, which is 3,36,000 divided by 32 lakh. So that's 10.5%. Then 2,88,000 divided by 26 lakh. That's 11.08%. then 2,40,000 divided by 20 lakh is 12%. Right? These are our cost of equity figures. These are the cost of equity figures, guys, for the question number 2. Okay. Okay, fine. Then let's do one thing, guys. Let's take a break now. Let's take a break of 10 minutes, and post that we will continue with the next model, which is about the net operating income, but with taxes. That is, we will bring into picture the tax, and due to taxation, what all changes are going to happen. And that's basically the model. Okay, Modi Gilani Miller model. We'll take it up after the break, guys. So let's take a break now. Are we offline? Uh, Welcome back, guys. After the break, let's go ahead with the next concept now. Let's go ahead with the next concept, which is about the Modigliani and Miller or model, which is simply net operating income with taxes. Okay. When we have tax in our capital structure, or when we have tax working in our surrounding, or we are living in an economy in which your income is being taxed, then basically how we compute or how we calculate the values. Right? So there are slight changes that are going to happen. First and foremost, value of debt, value of equity is going to remain same, PAT upon K. But when you have with the taxes, the formula is going to be changing as, value of firm will be actually, when you have taxes in your capital structure, the value of the firm will be EBIT upon Q. Sorry, it is same. Wait, hold on. It's EBIT 1 minus T. Value of the firm will be EBIT 1 minus T upon KO. Okay. But remember, this is going to be the formula of EBIT 1 minus T upon KO. This is going to be the formula for unlevered company. Unlevered company, that is the company which do not have any amount of debt in its capital structure. A company which do not have any amount of debt in the capital structure, that's your unlevered company. The formula for that is this. And essentially, this number EBIT 1 minus T is actually simply, EBIT minus EBIT into tax rate, right? That's nothing but without any interest. There's no interest, so obviously it's the same PAT figure, sir. Right? So you calculate the value of the firm using the PAT upon KO or PAT upon K, just one the same because it's an unlevered company. But for levered company, value of firm, which is a levered company, that is typically calculated by using a specific formula as value of firm unlevered, identical firm which is unlevered, plus the debt amount into the tax rate. The debt amount into the tax rate. Sir, what is the logic for that? Let me explain it to you. The logic for this thing is value of firm plus debt into equity. The logic is remember, cash flow for levered company will be higher. Cash flow for levered company will be higher due to tax savings on interest. So due to tax savings from interest, whatever is the amount of interest you are paying, remember it's a tax deductible amount. You can claim deduction, you can claim it as an expense, and you need not pay taxes on it. You can claim the deduction, you need not pay taxes on it. So there's a tax savings that's working. We're having tax savings that working, and that tax savings is on the interest. Right? So whatever interest you are paying, that is a tax deductible, and because of that you will save taxes. So due to saving of taxes, you will get a higher amount of cash flow as compared to a unlevered company. right? So unlevered company will have lower cash flow. Levered company will have a relatively higher cash flow due to tax savings. Obviously, from that cash flow only you pay money to your fund providers, like you pay money to your equity shareholders, you pay money to your debenture holders. Okay, but what you have as cash flow will be higher in case of levered company. So, sir, addition, or I can say, amount of tax saving, amount of tax savings per annum, amount of tax savings per annum will be, what will be the amount of tax savings per annum? Amount of tax savings per annum will be, can I say, interest, whatever interest you are paying, on that you are going to pay tax, right? On that you will be having a tax saving. So interest into tax saving. So present value of all tax savings, present value of all tax savings will be interest multiplied by T. Present value of all tax savings will be interest multiplied by T. Okay, so present value of all tax savings will be interest multiplied by tax saving for infinite years, right? So obviously you will divide it by KD. And we know, sir, it is interest upon KD into tax. What is this, sir? What is this interest upon KD? That is a value of debt, na? So value of debt multiplied by tax saving. This is the extra value. This is the extra value of levered form. So interest upon KD into T, that is the extra value of the levered form. The levered form is having this additional value, and that is just being added to it. So remember this formula, guys. Value of firm which is levered will be equal to value of the firm unlevered plus debt into tax rate. And also one more formula, which is value of firm is EBIT 1 minus T upon KO. That's also the value of the firm formula, but that's only for unlevered company. That's only for the unlevered company. Okay. So we need to remember this formula to look at the next question. Okay. So next is, we'll do question number 7. We'll do question number 7, guys. Question number 7. RES Limited is an all equity finance company. Pay attention for this question, guys. This question is extremely important and a bit of confusing if you look at directly the solution. So RES Limited is an all equity finance company with a market value of 25 lakh and cost of equity of 21%. Company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt of the same amount. Rate of tax may be taken as 30%. After the capital restructuring and applying model, you are required to calculate market value of RES Limited, cost of equity, weighted average cost of capital, and comment on it. What does levered means? Levered means the company which has taken a loan. Okay, so we are talking of the company RES Limited, which is in originality, it is a 100% equity finance company. So RES, which is having 100% equity. This is one company, RES 100% equity. The other is same as, but we are going to buy back equity shares worth 5 lakh by issuing perpetual debt of 15%. So RES, it is a levered form. Now for both the companies, let's do one thing. We'll first talk of what is the EBIT. We deduct interest. Then we get profit before tax. We pay taxes. We get profit after taxes. And then we write down also what is the KE, what is the KD, what is the KO. Cost of equity, cost of debt, overall cost of capital, KO. Then we have value of equity, value of debt, and value of firm. So all these things we are going to calculate for both the companies. So let's first prepare the income statement for both companies. Let's first prepare the income statement. So we have got a EBIT as a market value of 25 lakh. Company wants, let's write down whatever figures that are available. So here we have financed a market value of 25 lakh. It's an all equity company with a market value of 25 lakh. So the value of equity will be 25 lakh. Since it's a 100% equity, no value of debt, so value of the firm will be 25 lakh. Okay, then what all other information is given? Cost of equity is 21%. Cost of equity is 21%. Company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt. So cost of debt over here, it's not applicable. So typically overall cost of capital is 21%. Cost of debt is 15%. Cost of debt is 15%. Rate of tax is 30%. That's okay. But yeah, in this case, we're going to buy back equity shares and raising perpetual amount of debt. So let's raise the debt. So value of debt is given to be 5 lakh over here. Value of debt is 5 lakh. So we got all these things. Now, from this, we have to compute a lot of other things, right, guys? So first and foremost, remember, I have written whatever is given in the question. Now rest all calculations we are going to do, and I'm going to keep the numbers. I'm going to give the numbers typically for this so that it helps us in doing a lot of things. So now, first let's try to fill up this unlevered company or 100% equity company. So value of equity is 25 lakh. Cost of capital is 21 or KE is 21%. So if KE is 21%, I can get the profit after tax figure to be 21% of 25 lakh. 21% of 25 lakh. Okay. So 21% of 25 lakh. $5,25,000 is your profit after tax. Okay, this is the first thing that we calculated. Then after that, next thing that we have to calculate is, this is done. So now tax and PBT. So if you look at the tax rate is 30% anyways, guys. So if PBT is 100, tax is 30, PAT is 70. So if we do this cross multiplication, we can get the tax and this thing also. So 5,25,000 divided by 70 into 30, which is 2,25,000. A second. And our PBT is 2,25,000 divided by 0.3, which is 7,50,000. Right, so this is the third thing that we calculate. Now, once you have got this profit before tax, to be 7,50,000. Profit before tax is 7,50,000. Interest will be how much? So there's no interest over here, correct? So zero interest. So can I say my EBIT is also 7,50,000. So all these numbers are calculated by simply cross multiplication stuff. Okay, now talking about the levered form. So about levered form, we have to go from this way, because since it's a levered form, it doesn't really matter, sir, what is the amount of debt or equity. Your EBIT is going to remain same, which is 7,50,000, because even if you take a loan or if you don't take a loan, the income generated by the business for all the fund providers is one and the same. 7,50,000, that's remain constant. Yeah, but PAT may differ. Now the interest, this is the fifth thing that we did. The interest will be 5 lakh debt multiplied by 15%. $5 lakh debt multiplied by 15% point that we did. Then the tax rate of 35%, or 30%. That's 2,02,500. That's the eighth thing that we calculated. And finally, the profit after tax. Finally, the profit after tax is 4,72,500. 4,72,500. Okay, that's the ninth thing that we got. Now it's time for us to fill up all these portions. Now, to calculate KE, we will need profit after tax upon value of equity. So we don't know what is the value of equity. How will I get K? Not possible. Cost of debt, we have taken it to be 15%. But remember, guys, this is before tax cost of debt. And of course, it will be like 15% into 1 minus 0.3, which is 10.5% after tax. 10.5% after tax figure. So 15% is before tax, 10.5% after tax cost of it. That's fine. Overall cost of capital also we cannot calculate. KO, we can't. So value of equity, not available. Value of firm, not available. Now, how shall I solve this? Now to solve this, we'll take help of the formula. If you could remember, value of levered form will be value of unlevered plus debt multiplied by tax rate, which is value of levered is unlevered is 25 lakh plus debt is 5 lakh multiplied by 30%. 5 lakh multiplied by 30%. So the value of debt will be proportionately taken. So it's 5 lakh multiplied by 30% plus 25 lakh. Is 26 lakh 50,000. This is the figure that we computed right now. After this, after 9th, this is 10th. Okay. This is a 10th figure that we computed now. Now, after this, so we have value of firm, we have the value of debt. Can we get value of equity? Of course. Value of equity is simply 26.5 lakh minus 5 lakh, which is 21 lakh 50,000. 21 lakh 50,000. And then after we got this value of equity to be 21 lakh 50,000, now it's time to look for KE, and that KE is point number 12, which is 4,72,500 divided by 21 lakh 50,000. 4,72,500 divided by 21 lakh 50,000. 21.5. 98. This is 21.98%. You can see there's a marginal increase in the cost of equity because of perceived higher risk. Now talking about the overall cost of capital, KO. Talking about the KO, we can simply compute the KO by, as we compute normally the value of, as we normally compute the overall cost of capital, that is the way we compute the WACC, weighted average cost of capital. Right, so calculation of KO. For that we need equity, we need debt, we also need the weights. Equity, or before weights, we'll need the amount. Weights. So amount, equity amount is 21,50,000. Debt is 5 lakh. So weightage, we will get it accordingly as 26,50,000. So this is 21,50,000 divided by 26,50,000, which is like 0.8113, and this is 5 lakh divided by 26,50,000, which is 0.1887. Cost, we already have the costs computed. Overall cost of capital is 21.98 and KD is 15%. 21.98 and KD is 15%, right? No, sir, not 15%. We have to take it as after tax figure, 10.5%, right? 10.5. And then we take the product, take a summation of it. 0.8113 into 21.98%, which is 0.1783, 0.1887 into 10.5, 0.0198. So if I add both of them, 0.1783 plus 0.0198, which is 0.1981, or roughly you can say 19.81%. That is the overall cost of capital, 19.81%. This is the 13th and the last point that we come. So this is how the solution for this question 7 needs to be prepared. It's all a jumbled up puzzle sort of thing. So whatever is in white, those values are given to us. Whatever is in green, those values have been calculated. What are you saying? Here equity is 21,50,000. No. You're wrong. It's not that 21,50,000 is the market value and 20 lakh is the book value. No. This value of equity was also market value. After you buy back, the 20 lakh market value will become 21,50,000. We are not aware what is the book value of the company in this case. Because 25 lakh is also the market value, but that is the market value before buyback, before the scenario when the company is having any debt. So in the absence of any debt, you get the value of the company equity shares to be 25 lakh. After considering the buyback and employing 5 lakh of debt, you get the value as 21,50,000. Okay. Just give you a couple of minutes, guys. Just go through the solution once again, and then we'll go for the next concept. Let's go through this question once again, guys. How after tax KD came? After tax KD is like 15% is before tax, and you take 1 minus T. You might have done in cost of debt interest into 1 minus T upon the net proceeds. That's the same 1 minus T funda. Okay, guys. I hope we are good with this typical question, guys. Are you all good with this typical question? Yes, this is a past year exam question paper. If book, see, who is this? Charu, the entire chapter is talking about the market value. It is only talking about market value. Book value is not at all considered in this capital structure theory. No, sir. Wait, just a minute. I've given them to read the question actually for a 1 minute. Okay, calculation of KO. Have a look at it. This is the calculation of KO. So we had like equity and debt. We already got the values of equity and values of debt. We had the weightages. Cost is this 21.98 and 10.5. We took a product and simply calculated the overall cost of capital. Okay. Done. Perfect, guys. Then let's do one thing. Let's go for the next theory, which is Modigliani. Again, a MM model, Modigliani. But they are talking of MM arbitrage. Modigliani Miller arbitrage. So for arbitrage, yeah, Modigliani Miller. For that, we have this question number 10. Question number 10. See, there are two companies, Yen Limited and Yem Limited. Okay, I am like purposely pronouncing it in this way so that you don't get confused. Okay, so there are two companies, Yen Limited, Yem Limited, having same earnings before interest and taxes, that is EBIT of 20,000. Yem Limited is a levered company having a debt of 1 lakh at 7%. Cost of equity of Yen Limited is 10% and Yem Limited is 11.5%. Find out how arbitrage process will be carried out. Now for that, we need to first understand what is arbitrage. What is arbitrage? What do we mean by arbitrage? Ever heard of this term arbitrage? Arbitrage. Arbitrage is. What do we know about arbitrage? Let me just tell you something very simple. In anything, BSc, because I'll buy 1,000 and sell it at 1,005, I will get a sure shot profit of 5 rupees. Right? So just keep it in mind. Sir, what are we going to buy and what are we going to sell? We are going to sell high value thing. And we are going to buy low value. So as an arbitrator, as a person who wants to take arbitrage, you will buy in the market which is available at a lower price and you will sell it in the market in which it is being traded at a higher price. So we sell high value, we buy low value. Remember, just keep it drilled into your mind. We sell high value, we buy low value. Simple. Okay. Done. Now let's look at question number 10. So as per this question 10, Yem Limited and Yen Limited. There are two companies, Yen Limited and Limited, both having the earnings before interest and tax. So EBIT of 20,000. Interest is 7,000 because there's a debt of 1 lakh on that 7%. So debt of 1 lakh on that 7%. So 7,000 is the interest, and then we reduce the PAT, we obtain the PAT or PD. Considering the KE and KD, cost of equity of Yen is 10% and of M is 11.5%. Right, so it's 10% and 11.5%. So cost of debt is not applicable in N Limited because it's 100% equity. Cost of debt for M Limited is 7%. Okay. Now, value of equity, we can get it simply as 20,000 divided by 10% and 13,000 divided by 11.5%. Overall, value of debt over here it is 1 lakh. So we get the value of firm to be 2 lakh and 2 lakh 13,043. We just add both of them. Okay. So now tell me, as an arbitrager, where will you buy, or which company shares you are going to buy, which company shares you are going to sell? Tell me. In both the things, look at the value of the firms. Look at the value of both the firms. Look at value of both the firms and tell me which company shares are you going to sell, which company shares are you going to buy. Just tell me that. Yeah. N Limited buy and Yem Limited sell. Bang on. Perfect, guys. We are going to sell the shares of M Limited. We are going to buy the shares of Yen Limited. We are going to sell the shares of M Limited. We are going to buy the shares of Yen Limited. So how many shares? Let us simply consider. I will sell 10% shares of M Limited. Suppose I am an investor in M Limited. I am an investor in M Limited. I will sell 10% of it. Okay. So let's consider an investor with 10% stake in M Limited. So let us consider an investor with 10% stake in M Limited. So I am an investor who is having 10% stake in M Limited. So what am I going to do? Whatever is my stake, I will sell it in market. So today, if I'm going to sell 10% stake in M Limited, so sale proceeds from sale of 10% stake in M Limited will be 10% of 113043. It will be 10% of 1,13,043. So 11,304 is the amount that we will get in our hands. Okay, 11,304 is the amount of money that we'll get in our hand, that will get released in our hands. Now just think, was this 11,304 investment a risk-free investment, or was it a risky investment? Was this a risk-free investment, or was it a risky investment? I mean, when I was invested in M Limited, was I having this amount as a full claim on the company? Just think that if the company goes bankrupt, will I be the person first to receive this money, 11,304? No, sir. It is subject to risk. It is subject to risk because there was 1 lakh debt in M Limited. Now, if I'm going to invest my money in Yen Limited, suppose if I want to invest my money in Yen Limited, for this amount of investment, I should be having some loan, right? Because if I invest this 11,304 in this case, it will be totally fully equity investment. Whereas over here, when you were invested, the company was having loan. So that automatically percolates to you. The risk automatically percolates to you because if the company is having loan, if the company defaults, you will lose your equity capital. In this case, that's not the case. So now to match the risk profile, because in arbitrage, remember, the risk should be equal. If you're taking more risk and you're getting more return, it's a normal thing. What rocket science have you done? When you say you are earning something better, it means the risk remains the same. That is, whatever you were earning earlier, now also you're earning the same, but the risk is remaining same. So over here, it was risky because it was having some loan. Over here, there is no loan. So to match the risk profile of both investment, we'll take a loan of 10,000 at 7%. Sir, how do you get this 10,000? How do you get this 10,000? Because 1 lakh was the loan. 1 lakh was the loan upon 1.13043. This was the debt for this much equity multiplied by 1 lakh was the loan for 1.13043 equity. So of course, sir, for 11,304, how much should be the loan? That's like proportionate, simple, right? So for 11,304, we'll take a loan of 10,000 to match the risk profile. Why are we matching the risk profile? Why weren't we not in a position where we're matching the risk profile? Because earlier we were having a loan of 1 lakh. Earlier we were having a loan of 1 lakh, and we were having a loan of 1 lakh on the company. Now over here I'm taking the same loan on myself. So earlier it was indirectly loan on me. Now I'm taking a loan to have that direct loan impact. So 11,304 plus 10,000, that's 21,304 is the amount that you have. So let us do one thing. 21,304, we are going to invest in Yen Limited. If I invest in Yen Limited, percentage stake will I get? What will be the holding? How much percentage equity am I going to have? Let me just talk in terms of, those Shark Tank guys. equity कितना मिलेगा मुझे, right? How much equity am I going to get? So it's like 21,304 is the amount that we'll be investing. Total value of the company is 2 lakh. Out of 2 lakh, you will get 21,304 investment. So that's like you're getting 10.65%, more than 10% stake in that yen limited. So over here, I'm getting a better stake. I'm getting a higher stake, even after matching the risk profile. Let me look at what is my income. Right now, from an investment in yen limited, 10.652% into 20,000. Because here we'll be earning a profit after tax of 20,000, right? So that's like 10.652% into 20,000. So that's like 2130.4. So 2130.4 will be your earnings. Interest, you have taken a loan of 10,000. You have taken a loan of 10,000. On that, you have paid an interest, or you have to pay an interest of 7%, which is 700. So net profit will be 1430.4. Okay. So when I'm investing my money from this YEM limited to yen limited, what am I having? I'm having a net profit of 1430. What was my income before switching? That is when I was in YEM limited. What was the income that I was having? Sir, company was earning 13,000. I was having 10% stake. Company is having company was earning 13,000. I was having 10% stake. So if I was having 10% stake, it means I was earning 1,300. The profit attributable to me was 1,300. Right now, when I'm shifting from YEM to yen, I'm getting additional 130, because right now my income is 1430 and this is 1,300. So 130.4 is the arbitrage gain. 130.4 is the arbitrage gain. Okay. Second point again, listen to the second point. Okay, before that, let me just complete it. Since I'm having arbitrage gain, I, as an investor in M Limited, would not be interested in staying over here. I will shift from YEM to yen. I will sell yen and buy yen. Not only me, all the investors in the market are going to do the same. They will sell the shares of M Limited. They will buy the shares of yen limited. Over a period of time, what is going to happen? Value of equity of yen limited will start falling. Value of equity of yen limited will start rising. So obviously that will lead to ultimately both the values of the firm coming to equal, or coming to a par. So 2 lakh, it will increase. 2,13,000 will increase. They will, at one after point of time, they will come at par, unless and until there is arbitrage. There will be people who will be selling yen and buying yen. Perfect, guys. Now let me re-explain this second point. Listen. For the second point, we say we are going to sell 10% stake in M Limited. 10% stake is valued at 11,304. Now, this investment was not without any debt on it. It was not without any burden of debt. There was a burden of debt of 1 lakh on an equity of 1,13,000. So obviously, burden on this amount of investment of mine would be 10,000. If for 1,13,000 of equity, 1 lakh is the burden of debt. So for 11,304 of equity, what is the burden of debt? Burden of debt is 10,000. So total funds that are available will be 11,304 plus 10,000, which is 21,304. Okay, so total funds which are available is 21,304. Okay, those funds were invested, and then we find that there is an arbitrage gain. So over here, we can find that investors are actually shifting from where to where, from which company to which company, from YEM to yen. What was YEM? YEM was a levered company. Yen was a unlevered company. Yen was a unlevered company. Okay, so here the migration of my investors was from levered company to unlevered company. Migration was from levered company to unlevered company. There's another arbitrage possible from unlevered to levered. For example, let's say A and B same companies, EBIT, interest, everything same. KE is 10%, 18%, KD is 7%, debt of 1 lakh, and of course the value of equity and value of the firm is available. Now from where to where are we going to invest? From where to where are my investors going to shift? Are my investors going to shift from A to B or from B to A? From where are the investors going to shift? From A to B or from B to A? Tell me guys. My investors are going to shift from which company to which company? True. Obviously from A to B. I'll be shifting from A to B because A is having a more value, B is having a less value. So let us again assume that we have got a 10% stake. Let's assume an investor with a 10% stake in A who wants to switch to B. So an investor in A, after selling 10% stake, he would receive how much? Sir, out of 2 lakh, he will receive 10% money of that because he was having 10% stake in it. 20,000 is what he's going to receive. Now, with this 20,000, we will do one thing. We will invest 10% equity shares and 10% debt. So why so? Because, like again, the logic same over here. When my investment of 20,000 was over here, can I say it was without any debt burden? This was without any debt burden. That was without any debt burden. No debt, sir. Now, when you're going to invest over here, you will have debt. Right? When you're going to invest money over here, you will have amount of debt. You will have a burden of debt. So investment made is 10% of 72,222 plus 10% of 1 lakh. So why are we making it investment? So that I'm acquiring 10% stake in that company, but also I will acquire 10% stake in the debentures so that there is no risk over here. See, if I'm investing in equity shares, I'm also investing in debentures. I'm investing in the equity shares of the company. I'm also investing in the debentures of the company. So ideally, the risk is matched. Because if the company defaults, the company will definitely pay me first because I'm also a debenture holder. So earlier, when I was 100% equity company, when the company defaulted, if the company defaulted, I received that money fully because I was we were only the equity shareholders. Over here also, since I'm a debenture holder also, I will be getting the money, and also being an equity shareholder, I'll get the balance also. So investment made will be out of total value of 72,222, 10% I will acquire, and out of 1 lakh debentures, I will invest in 10% of that. So total investment is 17,222. So how much did we receive by selling our stake in A? So we got 20,000. Okay, so we got 20,000, but we invested only this. We still have this 2778 surplus with us. We'll talk about surplus later on. First, let us see what is the income. So on equity shares and on debt, it's like 13,000 into 10% and 10,000 into 7%. It's like 1,300 and 700. So total income is still remaining to be 2,000. Plus, remember, we had this surplus, 2778. So surplus funds available is 2778. So income on surplus is like 2778. Surplus on this. So 2778 into the surplus of it. Like whatever will be the rate of return that you get from surplus. In fact, you will see, sir, on equity shares of A Limited, you were earlier earning 2,000 only because the income was 20,000. On that, you were, you were a 10% stakeholder. So you were getting 2,000 only. So on equity of A, you were earning earlier 2,000. Over here also, you are earning like 2,000 plus also surplus on this. So again, we see there's an arbitrage possible. So investor will shift from A to B. So what will happen? Over a period of time, equity shares value will fall and value of equity of B will increase. So if that's going to be the case, both of them will match each other, and ultimately we will find that the value of both the companies will be equal after a point of time. So that is about this Motti-Gilani-Miller. Modigliani Miller have always been, proponents of, they've always been supporters of irrelevant. There is, whatever be the capital structure, the amount or the value of debt, value of the firm is going to remain same. Whatever be the capital structure, value of the firm is going to remain same. Okay, so that's our model, approach, both with taxes and without taxes also. They've given an alternate approach. They've given a different approach to, calculate the values or to prove that there's no arbitrage possible. So just put your queries, guys, in the chat box. Probably I'll answer that because I'm done from my part with regards to the capital structure. We have done all the theories, relevant theories as well as irrelevant theories. I'll just wait for some minutes, some time for your queries on the chat box, if any. Okay, any queries, guys? Please summarize the arbitrage. Sure, you can just view the video once again because that's already there. After the lecture is done, the last half an hour, you can just view it again. Any other queries, guys, with regards to this? So we have covered all the theories. So all 4 theories we have done: net income approach, net operating income, traditional approach, and Modigliani Miller, along with the numerical examples supporting the same theories. Okay. My part is done. Yes, your part is to start the practice of all module sums. Exactly, guys. Yeah, I'll definitely be uploading these PDFs, the questions, as well as this entire PDF. Entire my notes will be given to you. Don't worry about it. It has got all the solutions, my handwritten notes along with all the solutions, everything you'll get. So need not worry about it. Okay. Any other queries, guys? No? No queries? Clear, sir. Thank you. Okay. Fine then, guys. We'll stop here for the day. Yeah, with this, we are done with this chapter. Yeah. So let's stop here, guys. We'll probably meet again sometime later. I'll be uploading the PPT. Don't worry. Arbitrage. Show the screen of M&N arbitrage. Okay. Yes, yes, it is. I'll just do one thing. Put the things together. Yeah, you can have a look at it. But yeah, if you want, you can take a screenshot of it. Okay, I'll just wait for a minute for you to take a screenshot and then we'll just call it a day. Okay, so I think we have might have taken a screenshot. Then let's stop here for the day, guys. Good night, take care, bye bye, and take care. Bye, guys. Done, sir. Yes, concluded, sir.